When the world talks about AI, nearly all the attention goes to one company. Nvidia. Its stock has become the symbol of the artificial intelligence revolution. Its CEO has become one of Silicon Valley's most recognizable figures. And its GPUs have become some of the most sought-after products in the world. But business history teaches us an important lesson. The most famous company is not always the company that makes the most money. During the California gold rush, thousands of prospectors searched for gold. Yet many of the greatest fortunes were built by those who sold the picks and shovels. Today, in the modern AI gold rush, Nvidia may be the miner. But Broadcom may be the company selling the picks and shovels. And that is exactly what this analysis is about. Not simply why Broadcom benefits from AI, but why Broadcom may be building one of the most powerful cash-generating machines in modern technology. When investors talk about the AI boom, one name dominates the conversation. Nvidia. When investors talk about cloud computing, they often mention Microsoft, Amazon, or Google. But very few people talk about Broadcom. And that is exactly what makes the company so interesting. Because while other technology companies capture headlines, Broadcom quietly operates behind the scenes. Most consumers have never purchased a Broadcom product. Many have never even heard of the company. Yet they interact with technologies powered by Broadcom every single day. Whether you're using Wi-Fi, streaming content, storing data in the cloud, or accessing enterprise applications, there is a good chance Broadcom technology is involved somewhere in the process. That's because Broadcom doesn't build products that consumers see. It builds the infrastructure that allows modern technology to work. And throughout history, infrastructure businesses have often become some of the most valuable businesses in the world. Think about it this way. Most people know the airlines. Few people know the companies that build airport infrastructure. Most people know the websites they visit every day. Few people think about the networking equipment moving data behind the scenes. Yet without that infrastructure, none of those services could operate. Broadcom plays a similar role in the digital economy. The company has spent decades building positions in technologies that are absolutely critical, but largely invisible. And that's an important distinction. Because when technology becomes critical to a customer's operations, replacing it becomes difficult. Customers don't switch vendors simply to save a little money. They prioritize reliability, performance, and trust. That creates a powerful competitive advantage. Today, Broadcom's business extends far beyond semiconductors. The company is a leader in networking infrastructure. It designs custom chips for some of the world's largest technology companies. And after acquiring VMware, it also became a major player in enterprise software and virtualization. In other words, Broadcom is no longer just a chip company. It is an infrastructure company. And that difference matters. Because infrastructure businesses tend to benefit regardless of which specific technology trend wins. Broadcom doesn't need to predict which AI model becomes dominant. It doesn't need to know which application becomes the most popular. It simply benefits as more computing power, more data, and more AI workloads move through the global digital economy. That's what makes Broadcom different from many technology companies. Its success isn't tied to a single product. It's tied to the growth of the entire ecosystem. And as artificial intelligence continues to expand, that ecosystem is becoming larger and more important than ever before. Which brings us to an interesting question. If Broadcom is so important to the technology industry, why do so few investors talk about it? The answer is simple. Because Broadcom isn't the hero of the story. It's the infrastructure behind the hero. And in many cases, that's where the real money is made. Before we examine Broadcom's role in artificial intelligence, we first need to understand the environment where AI actually operates. Because artificial intelligence doesn't run on a single machine. It runs inside massive data centers specifically designed to handle enormous computational workloads. At first glance, an AI data center may look similar to a traditional cloud data center. Rows of servers, storage systems, networking equipment, and thousands of cables connecting everything together. But AI introduces a completely different level of scale. Training a modern AI model requires processing vast amounts of information across thousands of computing devices simultaneously. This creates three fundamental requirements. The first is computing power. AI models perform trillions of mathematical calculations while learning patterns from data. The second is storage. The larger the model, the more data must be stored, retrieved, and processed efficiently. The third is communication. Every computing device must continuously exchange information with other devices throughout the training process. These three elements, compute, storage, and communication, form the foundation of modern AI infrastructure. And they must operate together seamlessly. If one component falls behind, the entire system becomes less efficient. This challenge becomes even greater as AI models continue to grow. A model that requires 10 times more computing power often requires significantly more data movement and coordination as well. As a result, building AI infrastructure is no longer just about adding more processors. It is about designing systems capable of managing increasingly complex workloads at scale. That is why the world's largest technology companies are investing heavily in every layer of the AI stack. Not just in processing power, but in the supporting infrastructure required to keep these systems operating efficiently. Understanding this architecture is important because it reveals a key reality about artificial intelligence. The performance of an AI system depends not only on the strength of its individual components, but on how effectively those components work together. And as AI systems become larger, the importance of system-level design continues to increase. As AI systems become larger, a new challenge begins to emerge. Not computing. Coordination. Building a powerful processor is difficult. But getting thousands of processors to work together efficiently may be even harder. For many years, the semiconductor industry focused primarily on increasing computing performance. More transistors. More processing power. More speed. But modern AI has changed the equation. Today, performance is no longer determined solely by the strength of an individual chip. It increasingly depends on how effectively thousands of chips operate as a unified system. Imagine an orchestra. Having the world's best musicians does not guarantee a great performance. Without synchronization, even extraordinary talent can produce chaos. The same principle applies to AI infrastructure. As computing clusters expand, the ability to coordinate and move information efficiently becomes a critical factor in overall system performance. This is where networking moves from a supporting role to a strategic one. And this shift is creating one of the most important opportunities in the AI era. Historically, networking represented a relatively small portion of data center spending. Processors received most of the attention because they performed the actual computations. But AI is changing that balance. As organizations deploy larger and larger AI clusters, the amount of information moving between machines is growing at an extraordinary pace. Every increase in computing power creates additional communication requirements. More processors generate more data exchanges. More data exchanges require greater bandwidth. And greater bandwidth demands increasingly sophisticated networking solutions. In other words, networking scales alongside AI. This dynamic creates a powerful economic advantage. Because unlike many areas of technology where competition can quickly erode profits, networking infrastructure often becomes deeply integrated into customer environments. Once a large-scale architecture is deployed, reliability becomes far more important than experimentation. Customers prioritize stability, performance consistency, compatibility, and long-term support. These characteristics naturally favor established suppliers with proven technologies. The result is an industry where trust and execution matter just as much as innovation. And that creates higher barriers to entry than many investors realize. For a hyperscaler investing tens of billions of dollars into AI infrastructure, replacing a critical networking layer is not a simple decision. The risks extend far beyond hardware costs. Any disruption can affect performance, deployment timelines, and operational efficiency. That reality gives networking providers a degree of strategic importance that is often overlooked by the market. While investors focus on the next generation of processors, some of the most durable value may be created by the technologies that enable those processors to function at scale. This is precisely why networking has become one of the most important battlegrounds in artificial intelligence. Not because it generates the most headlines, but because it has become essential to unlocking the full value of AI infrastructure. And among the companies operating in this space, few have the scale, engineering expertise, and customer relationships that Broadcom has built over decades. The market often assumes that the hardest challenge in AI is building a faster chip. But as AI clusters continue to grow, an equally important challenge is ensuring that every chip can work together efficiently. And that challenge may prove far more difficult to solve than many investors currently appreciate. The importance of networking is not just a technology story. It's also an economic story. And this is where many investors underestimate the opportunity. When a new technology emerges, attention usually flows toward the most visible component. In the AI era, that component has been the GPU. And for good reason. GPUs are responsible for the computational breakthroughs that made modern artificial intelligence possible. But as AI infrastructure scales, the economics of the system begin to evolve. The challenge is no longer simply adding more computing power. The challenge is ensuring that additional computing power can be utilized efficiently. Imagine a company doubles the number of processors inside an AI cluster. In theory, performance should double. In reality, that rarely happens. Because larger systems create greater coordination requirements. More information must move between machines. More workloads must be synchronized. And more data must travel across the network. As a result, every new generation of AI infrastructure increases the importance of efficient communication. This creates a powerful feedback loop. More AI spending drives more computing. More computing drives more network traffic. And more network traffic drives demand for advanced networking solutions. In other words, networking benefits from the same trend driving demand for AI processors. But there is an important difference. The market often evaluates processors based on product cycles. A faster chip can replace an older one. Networking infrastructure operates differently. Its value comes from enabling the performance of the entire system. When customers invest billions of dollars into AI infrastructure, they are not simply buying components. They are building long-term platforms. And once those platforms are deployed, reliability becomes critical. No organization wants to redesign a complex architecture every year. That reality creates a business environment where customer relationships can become highly durable. And durable relationships often lead to durable cash flows. This is one reason why networking businesses can be extraordinarily attractive. Success is not determined only by selling more hardware. It is determined by becoming part of the customer's long-term infrastructure strategy. The market tends to focus on breakthrough products. But some of the most valuable businesses are built around essential functions that customers cannot easily operate without. And in the age of artificial intelligence, moving data efficiently is becoming one of those essential functions. If networking is Broadcom's first AI growth engine, there is another opportunity that could be just as important over the next decade. Custom silicon. And unlike networking, this business is not about connecting AI systems. It's about helping build them. For years, the AI industry has largely relied on commercially available processors. Companies purchased the hardware they needed and deployed it across their infrastructure. That model worked well when AI workloads were relatively limited. But as artificial intelligence becomes a core part of business operations, the economics begin to change. The world's largest technology companies are now spending tens of billions of dollars annually on AI infrastructure. At that scale, even small improvements in efficiency can create enormous financial benefits. As a result, many hyperscalers are no longer asking how many chips they should buy. They're asking whether they should design some of their own. This is where custom silicon enters the picture. Rather than purchasing a general-purpose processor designed for a broad range of customers, a company can develop a chip optimized for its own specific workloads. The objective is not necessarily to build a more powerful chip. The objective is to build a more efficient one. A chip designed around a specific task can often deliver better performance, lower power consumption, or lower operating costs. And when infrastructure budgets are measured in billions of dollars, those advantages become extremely meaningful. This trend is becoming increasingly visible across the technology industry. Many of the world's largest cloud providers are investing heavily in proprietary silicon strategies. Not because they want to become semiconductor companies, but because they want greater control over the economics of AI. For these organizations, custom silicon is not simply a technology decision. It is a strategic decision. A successful chip program can improve performance, reduce costs, and decrease dependence on external suppliers. But designing advanced processors is extraordinarily difficult. The expertise required is measured in decades, not years. Most hyperscalers possess world-class software talent. Far fewer possess the engineering capabilities needed to bring complex semiconductor designs into production. This creates a natural opportunity for companies with deep experience in chip architecture and system design. And that is where Broadcom has established a unique position. Instead of competing directly with its customers, Broadcom collaborates with them. The company provides the engineering expertise necessary to transform custom silicon concepts into production-ready solutions. In many ways, Broadcom acts as an enabler rather than a competitor. And that distinction is important, because it allows the company to participate in one of the fastest-growing segments of the AI market without taking on the risks associated with building a proprietary AI platform. As demand for artificial intelligence continues to expand, the number of organizations pursuing custom silicon strategies is likely to increase. Some projects will succeed. Others will fail. But the broader trend appears clear. The largest technology companies are seeking greater control over the infrastructure that powers their AI ambitions. And every step in that direction creates additional opportunities for partners capable of designing highly specialized silicon. For investors, this represents something significant. Broadcom is not dependent on a single AI trend. If organizations continue purchasing large volumes of AI processors, Broadcom benefits through its infrastructure businesses. If organizations increasingly pursue custom silicon, Broadcom can benefit there as well. In other words, Broadcom is positioned on multiple sides of the same AI transformation. And that diversification may ultimately prove to be one of its greatest strengths. In technology, innovation often receives the most attention. New products. New architectures. New competitors. The market tends to focus on what could replace today's leaders. But for investors, an equally important question is often overlooked. What would it actually take for customers to switch? Because replacing a critical technology supplier is rarely a simple purchasing decision. In many cases, the greatest challenge is not adopting something new. It's unwinding what already works. Large technology environments are built over years, sometimes decades. Systems are integrated. Processes are optimized. Teams are trained. Operational standards are established. Over time, these individual components become part of a larger operating framework. And the more successful that framework becomes, the harder it is to change. This creates an important dynamic. Customers do not evaluate infrastructure solely on performance. They also evaluate stability, reliability, compatibility, and the potential consequences of disruption. Because when infrastructure supports mission-critical operations, even a small interruption can create significant costs. As a result, decisions are often driven by risk management rather than pure price comparisons. The cheapest solution is not always the preferred solution. The newest solution is not always the preferred solution. What matters is confidence that the system will continue performing as expected. That confidence becomes increasingly valuable over time. Especially in environments where downtime, performance degradation, or unexpected integration issues can have meaningful operational consequences. This is one reason infrastructure markets often behave differently from consumer technology markets. Consumer preferences can change quickly. Infrastructure decisions tend to evolve much more slowly. Organizations may upgrade. They may expand. They may modernize existing systems. But wholesale replacement is typically approached with caution. For investors, this distinction matters. Because businesses operating within critical infrastructure often benefit from a degree of resilience that is not immediately visible in quarterly results. Their competitive position is not based solely on having the newest technology. It is strengthened by the accumulated trust built through years of successful execution. And trust, once embedded into critical operations, can become a powerful competitive advantage. The strongest systems are not always the ones that attract the most attention. Often, they are the systems customers rarely think about. Because they simply work. And when a system consistently delivers the performance customers expect, the cost of changing it becomes far greater than the cost of keeping it. When investors look at Broadcom, they often try to understand the company through its products. But over time, Broadcom has proven something more important. The outcome of the business is not only driven by what it owns. It is shaped by how decisions are made. And in Broadcom's case, those decisions are highly centralized and long-term oriented. This creates a different kind of predictability compared to most technology companies. Not predictability in revenue growth, but predictability in behavior. Capital is not scattered across dozens of experiments. It is directed toward a small number of areas where management believes returns can be clearly understood and measured over time. This approach changes how the company responds to industry cycles. When demand accelerates, Broadcom does not aggressively expand into unrelated areas. When conditions slow down, it does not overreact by restructuring its entire strategy. Instead, the focus remains on optimizing the existing portfolio. For investors, this creates an important implication. Broadcom is not a company that reinvents itself every few years. It is a company that compounds through repetition of the same decision framework. That framework prioritizes three things: scale in chosen markets, strong positioning within those markets, and the ability to convert that position into long-term value. This is why Broadcom often behaves differently from typical semiconductor peers. Where others may expand broadly to capture new opportunities, Broadcom tends to deepen exposure where it already has structural advantage. Over time, this creates a business profile that is less driven by narrative shifts and more driven by execution consistency. And in markets like semiconductors and infrastructure software, consistency often matters more than novelty. Because customers in these industries are not buying experimentation. They are buying reliability at scale. From an investor perspective, this means Broadcom should be evaluated less as a story of technological innovation, and more as a system that repeatedly allocates capital into areas where it can maintain long-term relevance. That distinction is subtle, but important. Because it explains why the company can appear conservative in strategy, yet still produce strong long-term outcomes. And it sets up a final question. If the business model is built on consistency and long-duration cycles, then the real issue for investors is not whether Broadcom can grow. It is whether that growth is already fully reflected in expectations. After understanding Broadcom's position in AI infrastructure, one thing becomes clear. This is not a normal semiconductor company. And the market knows that. Over the past few years, Broadcom has gone through a significant re-rating. Not because the company suddenly changed its identity, but because investors began to recognize the importance of its role in the AI ecosystem. When a company is re-rated, the key question is no longer about business quality. It becomes about expectations. Because even exceptional businesses can become poor investments if the price already reflects too much future success. To understand Broadcom today, we need to separate two things. What the business is capable of delivering, and what the market is currently assuming it will deliver. Broadcom benefits from multiple structural drivers. But the critical question for valuation is not whether these drivers exist. It is how much of them are already embedded in the stock price. At current levels, the market is no longer treating Broadcom as a traditional infrastructure company. It is being valued as a strategic AI enabler with long-duration growth visibility. That shift matters. Because when a company transitions from being underappreciated to widely recognized, the nature of returns changes. Early-stage re-rating tends to be driven by multiple expansion. Later-stage returns depend more heavily on earnings delivery. In other words, the easy part of valuation adjustment may already be behind the stock. From here, future returns are likely to depend more on execution than narrative re-rating. That does not make the business less attractive. But it does change the risk-reward profile. At this stage, investors are no longer asking whether Broadcom is relevant in AI. They already accept that it is. The real question becomes how much growth is realistically achievable over the next several years, and how much of that growth is already reflected in current valuation levels. Because when expectations become high, even strong results may not be enough to drive outsized returns. This is the classic challenge of investing in high-quality compounders. The business continues to perform well, but the stock must constantly justify a higher standard of performance. And that is where valuation becomes critical. Not as a prediction tool, but as a reality check against expectations that have already been priced in. After understanding Broadcom's business, its position in AI infrastructure, and its long-term growth opportunities, we arrive at the most important question. What is the stock actually worth? Because investing is not only about finding great businesses. It's also about understanding the price you're paying for future growth. The stock market can change its opinion overnight. The economics of a great business usually change much more slowly. That distinction is what makes valuation so important. Based on my valuation framework, I estimate Broadcom's fair value at approximately $370 per share. This represents a balanced scenario that assumes continued growth in AI-related demand, stable execution from management, and ongoing contributions from both its semiconductor and software businesses. However, valuation is never a precise science. The future rarely unfolds exactly as expected. That's why I prefer working with a range of outcomes rather than relying on a single target price. In a more conservative scenario, where AI infrastructure spending grows at a slower pace and market expectations become less optimistic, Broadcom's value could be closer to $330 per share. This doesn't imply that the business is broken. It simply reflects a future where growth remains healthy but falls short of the market's most optimistic assumptions. On the other hand, if AI adoption continues accelerating, custom silicon programs expand successfully, and Broadcom strengthens its position across key growth initiatives, the valuation could approach $492 per share. This scenario assumes that several favorable developments occur simultaneously and that management continues executing at a high level. The key takeaway is not whether Broadcom ultimately reaches one specific number. The key takeaway is understanding the relationship between price and expectations. The higher the valuation, the more future success investors are already assuming. The lower the valuation, the more room there may be for positive surprises. And that distinction matters. Because the quality of a business and the attractiveness of a stock are not always the same thing. Broadcom is clearly a high-quality business. The more important question is whether future growth will exceed, meet, or fall short of the expectations already reflected in the share price. For me, the fair value sits around $370 per share. That estimate is not a prediction of where the stock will trade next month or next quarter. Rather, it represents my assessment of what the business is worth based on its long-term earnings power and growth prospects. Ultimately, valuation is not about forecasting short-term market movements. It is about determining whether the long-term opportunity justifies the price being paid today. And in Broadcom's case, that decision comes down to a single question. How much confidence do you have that the company can continue compounding value throughout the next decade of AI-driven infrastructure growth? After examining Broadcom from multiple angles, a clear picture begins to emerge. This is not simply a semiconductor company. Nor is it merely another beneficiary of the AI boom. Broadcom occupies a unique position within the technology ecosystem. Its businesses sit at the intersection of several long-term trends that are reshaping the digital economy. Artificial intelligence, cloud infrastructure, enterprise software, and the growing demand for increasingly complex computing systems. What makes Broadcom particularly interesting is that its investment case does not depend on a single product or a single technology cycle. The company participates across multiple areas of modern infrastructure, creating a business model that is both diversified and deeply embedded within some of the most important technology platforms in the world. That diversification matters. Because technological leadership can change. Products can evolve. Competitive dynamics can shift. But companies that become essential to how an industry operates often enjoy much longer periods of relevance. Broadcom appears to be building exactly that kind of position. Throughout this analysis, one theme has appeared repeatedly. Scale. As AI systems become larger, infrastructure becomes more important. As data volumes increase, connectivity becomes more important. As technology spending grows, operational efficiency becomes more important. And Broadcom is positioned where many of those trends converge. That does not mean the company is without risks. No investment is. Competition remains intense. Technology evolves rapidly. And market expectations can sometimes move ahead of business fundamentals. These are realities every investor should recognize. But investing is ultimately a process of weighing probabilities, not certainties. And from that perspective, Broadcom possesses several characteristics that long-term investors often seek. Strong competitive positioning. Exposure to structural growth trends. High-quality customers. Significant cash generation. And a management team with a demonstrated ability to create shareholder value over time. Perhaps the most important conclusion is this. Broadcom does not need to become the most talked-about company in artificial intelligence to be a successful investment. It does not need to dominate headlines. It does not need to capture all the attention. It simply needs to continue doing what it has done for years. Providing the technologies and infrastructure that enable the digital economy to operate at scale. Which brings us back to the title of this analysis. Nvidia may be the company that captures most of the attention. And deservedly so. Its achievements have helped define the AI era. But investing is not a popularity contest. It is a search for businesses capable of creating value over long periods of time. And Broadcom may be one of the clearest examples of that principle in today's market. The market often celebrates the companies at the center of the spotlight. Yet some of the most successful investments come from businesses quietly enabling the entire ecosystem behind that spotlight. And that may be the most important takeaway from Broadcom's story. Nvidia gets the fame. Broadcom gets the money. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching, and if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.